So that's a beautiful picture of Basel, Switzerland. In Basel, there's a thing called the Bank of International Settlements. And basically, it's a bank for central banks. So if you thought the world was confusing, that there's banks, and then there's the Federal Reserve, which is like the bank for the banks. Well, then there's this Bank of International Settlements, which is kind of like a bank for the central banks. It's not supposed to exist. At the end of World War II, the countries of the world got together and created this thing called Bretton Woods, and we'll mention that a little bit when we get to chapter 18, which is soon because we're at 15. But anyway. A part of the Bretton Woods system was that the Bank of International Settlements would go away, the BIS would go away. And its replacements are the International Monetary Fund and the World Bank. So there's not supposed to be a BIS. But that was 1947, so it's probably not going away. Anyway, a committee under this Bank of International Settlements that is the group of all the central banks, they created something that we call Basel III, which is a global regulatory framework. Coming out of the financial crisis of 2007, 8, 9, all of the central banks realized that what they were doing wasn't sufficient. They weren't paying enough attention to what the banks were doing. They weren't setting up a system. The system that they had in place, the fractional reserve system, wasn't providing adequate coverage. The banks didn't have enough assets, right? They didn't have enough liquidity. They weren't able to survive without a lot of help from the government, and they didn't want to do that anymore. So Basel III is this idea of things like this liquidity coverage ratio, like stress tests. It lays out a whole bunch of things that central banks should do within their country to try to make the system more stable on its own. So the idea of this Basel III, this global regulatory framework, and this is how you get conspiracy theories, right? Because you have an agency that's not part of any government anywhere, and it's telling every country in the world how to set up its financial system. Okay? But the U.S. largely follows this Basel III, and that's where we get this liquidity ratio and where we get stress tests and things like that. Okay? So again, this liquidity coverage ratio, it's about what they call high-quality liquid assets. So again, the basic document's 103 pages long, and then there's more. So if you're bored, right, you're sitting up one night and you cannot get to sleep, go to the BIS website and download Basel III and try to read it, and I guarantee you be snoozing soon. Okay? But the point of it is to not measure, not take the deposits of the bank and say, you got to keep 10% of your deposits. The point of this liquidity coverage ratio is to say your bank has to have high-quality liquid assets. It has to have enough high-quality liquid assets that it can cover its normal operations for at least a month in a crisis without help. All right, just think of it that way. And we'll talk about what the HQLAs are in a second. So again, we want the bank to survive a stressful 30-day period without any help. Again, in the old days, if you had to keep 10% and the economy comes under stress and loans aren't doing it, you might have to cut back on things. You might have to do things that are bad for the economy just to meet your 10%. And that 10% is just a random number that it's based on your deposits. It's not really based on what you're doing, your financial operations, blah, blah, blah. So the idea of the LCR is what a bank has to have, its resources, its assets that it has to keep in the bank are determined by what its operations are like. And banks with riskier operations are going to have more liquidity. Banks that are doing, right? So there's ratios, there's all this stuff, and it's complicated. But basically, what the bank has to do is keep a bunch of reserves, cash reserves, right? Money at the Fed or money in the bank, plus Treasury securities, plus mortgage-backed securities. Keeps those three things in a quantity defined by these hundreds of pages of documents based on the operations of the bank. And that theory says when a crisis hits, like what happened in 2020, the Fed doesn't have to go in and bail out banks because banks have enough of these high-quality assets that they can cover themselves. If something happens, they can sell those assets or use those assets to cover their operations. They don't have to come screaming to the Fed because they're about to go bankrupt. Okay? That's the idea behind this. That instead of the Fed having to watch and throw it, the system is able to take care of itself in a short-term crisis. It's able to function through it because the banks have these high-quality liquid assets that they can use to cover their operations. Okay? Now, why are mortgage-backed securities liquid? Good question, huh? All right. So there's a thing called a repo market. The repo market, and there's actually more than one repo market, but keep your life simple. Repos are short for repurchase agreements. Here's the deal. In a repo, in the repos that we're talking about, a bank needs cash. It needs reserves. And it has a bunch of mortgage-backed securities. There's a market where the bank can basically sell those securities to another bank, including the Federal Reserve. The Federal Reserve is a bank in this world. So the Federal Reserve could buy those mortgage-backed securities, and sometimes it does. But another bank buys them or the Fed buys them and gives the original bank cash. So I'm Bank of America. I'm short. I need cash. I take a bunch of my mortgage-backed securities. I go to the repo market. I say, hey, who wants to buy these? In the repo market, it's not a permanent buy. So Wells Fargo buys those bonds from mortgage-backed securities, those bonds from Bank of America, and gives Bank of America cash. Maybe for 30 days. Maybe this is a 30-day deal, right? That's the kind of deal this is. It's like a 30-day deal, maybe. Maybe not even that long, but maybe it's a 30-day deal. Okay? At the end of that 30 days, why it's called a repurchase agreement is that Bank of America has already agreed to buy those bonds back at a higher price. So if I sold those bonds to Wells Fargo and they gave me $1 billion, a month from now, I buy those bonds back for $1 billion, 20 million. And they made $20 million in a month, Wells Fargo did, and I was able to cover my financial shortfall. Okay? Does that make sense? You're going, no, it doesn't make sense. Why would they do that? Well, banks have all these options, like the Fed funds market, where they can obtain short-term financing, basically, from each other, where they cover each other with short-term loans, right? And that's what the repo market is. It's a short-term loan. You buy these bonds from me, you give me cash. A month from now, I pay you more cash back, and you give me the bonds back. And we all end up where we started, except Bank of America paid a fee, basically, to Wells Fargo to bail them out when they needed that extra cash. Okay? Is that fun? So again, the government security, cash funds go from the lender, government securities go from the seller, and then at maturity, which might be a week, a month, whatever, the government securities come back to the original bank, and the cash plus interest goes to the lender. And that's the repo market. Now, the repo market has had issues at times during the early part of 2020. And every time it does, the interest rate starts to go up because there aren't ample reserves, right? There have to be ample reserves to keep interest rates from going up. If there's not enough money in the repo market, the Fed steps in and starts buying and buying and buying and buying. And now there's enough cash in the repo market, and they keep the interest rate down where they want it. Okay? Yes? Ample reserves. Everything's about having ample reserves. Now, we've talked about things like open market operations, right? Buying and selling bonds. We've talked about the fact that there's a discount rate. This is a list of all the tools the Fed lists on its website as things that it does. So it doesn't have any reserve requirements now, but if 4 of the Fed governors agree, they can put reserve requirements in anytime they want to. And they even can put them in for individual banks and not for the whole system. Right? There's interest on required reserves. There's overnight repos. There's the term deposit facility, the commercial paper funding facility, the primary dealer credit facility, the money market mutual fund liquidity facility. Okay? All of these are ways to make sure that within our financial system there are ample reserves. Okay? They're targeting, each one of those things down there is targeting specific parts of the financial system as a way for the Fed to add reserves into that part of the system. Okay? What the Fed does there, Jay Powell there, what they do is very complexical. We like to think that it's really simple, but it's in many ways very complexical. That's why they have a big staff and fancy offices. Okay? And they're doing all this stuff all the time behind the scenes that normal people don't see to try to make sure that there's reserves in the financial system and that the financial system is stable. Are we good? Okay. So there's another interest rate that matters to us, and that interest rate is the Libor. It's also the name of a great science fiction novel where the Libor are the aliens. But that's not what we're talking about here. The Libor stands for London Interbank Offered Rate. It's actually a set of interest rates going from 1 night all the way up to 1 year. And there's like 7 different variations of it within that 1 night to 1 year thing. The Libor is a global interest rate. There are other interest rates out there that do the same thing. The Fed funds is one of them, but the Fed funds is only an overnight interest rate. There are, see that number there? $450 trillion worth of financial contracts in the world that are based on the Libor. $450 trillion of financial contracts that are based on the Libor. So your bank, you have a line of credit at your bank with an interest rate. Very often that line of credit does not have a fixed interest rate. It doesn't say you can borrow against this at 3% all the time. Most often those lines of credit are Libor plus. So the interest rate that you're paying is one of these 7 Libor rates plus 1% or 2% or something like that, so the bank can turn a profit. Okay? This Libor is used all across the world as the basic interest rate. And again, there's 7 different ones of them, but easier just to think of it being an interest rate. Okay? And there's $450 trillion worth of contracts that are built off the Libor. So these interest rates, like the Libor, the Fed funds rate, these are very important interest rates because they're affecting all of these contracts, all these loans, all these deals that are made are built off of this Libor, which, again, Fed funds is one of the U.S. equivalents. Okay? Is that exciting? Okay. Don't believe me. For normal people, for most of us, again, this comes down to faith. We just have to have faith in the financial system. We don't have any way to make sure that the Fed's handling the repo market correctly. We have to have faith and believe in the financial system. And as long as most people just believe in the system and trust it, then in the end it will all work out for the better. But you got to have faith.